Good afternoon. This is Tom Alexander. It is Sunday, May 7th, and it is 1:26 p.m. Eastern Time in beautiful Charleston, South Carolina. This is the video addendum to the written report I send every week that all of you should have received. If you're finding me on YouTube by searching around and this is your first experience with this, welcome. And if you would like to receive a free written report that goes into this and show you the charts, etc., send me an email, tom@alexandertrading.com. I will put you on the list. It's free. I send it out every week. You'll be notified when this is available, for instance, as well as other free stuff that I send out. Okay, so we've really gone net nowhere for about the past 5.5 weeks and counting in the stock index futures, and it's a time where you can get on any social media app or YouTube and you can see very, very wild guesses. The market's going up because we're in a bull market. The market is on the verge of imminent collapse because we're in a bear market. And then all the reasons are given and they're valid. The bullish reasons are valid. The bearish reasons are valid. And that's great. But if you are a trader, what you really care about is what price is doing. And price has really gone nowhere for the past month. It's been an incredible churn with the continued disparate activity among the indices that we've seen since the October lows of last year. And let me show you the charts here, and we'll start talking about the charts. So I really don't care what kind of analysis that you ascribe to, whether it's fundamental analysis or technical analysis. There's a big debate in both camps, bullish or bearish. And again, you can make the case either way. Really intelligent people in both camps are bullish. Really intelligent people in both camps are bearish. So what do you do? Well, I don't really, I don't want to I don't want to label myself, and I don't want to be labeled as a type of analyst or a type of trader. But if you're going to label me, I'm a price action trader. I view market price action through the lens of auction market principles. And that basically is founded in what buyers and sellers do. Buyers and sellers determine the important levels. And if the market's going up, there are more buyers than sellers for whatever reason. And it's not quite that simple, but it pretty much is that simple. When the market's going up, you want to be really careful, depending on the time frame, about fading that market, because at that point in time, the market is looking for value higher. So where are we now? Well, we're in different places depending on the index that you look at. What you're looking at on my screen are the 4 primary U.S. trading indices, the weekly charts. The most bullish chart is that of the NDX, which should come as no surprise. I saw a statistic, I think it was from Market Ear, that I think it was 95% of the rally in the S&P this year has been because of 16 stocks. And those 16 stocks are obviously in the NDX. The NDX is at a level, there is nothing above Friday's highs, last week's close in the NDX that could be potential quote unquote resistance. Again, I don't use magic numbers. I use price action from what has occurred. And the next level to the upside to keep an eye on includes this high that formed, I think it was in August. Yeah, middle of August high. And this is your general area to keep an eye on. And to the downside, we're not going to have any really significant move, another bear leg unless this level is taken out. Now, we can fine tune that by going down in time frame, and we'll do that. But let's look at the SPX. And it's stuck in this range with a high from January, and then last week and the week before, sort of a double bottom. And then this is roughly around 4,200, which is a nice round number that you'll have all these option strikes, and you'll have Hal 2000 and his friend kicking in things around that area. But the reality is, just from a price perspective, if you get above 4,200, there's really nothing from an auction market perspective until, again, the August 15th high, which is just north of 4,300 in the SPX. Let's go to the Dow. The Dow is in a similar position as the S&P short term. There's a lot, we have this quadruple top right in this area around 34,330-ish. And then you have 34,730. And then above there, the air gets thinner and thinner to all-time highs. And then, of course, you've got to get below last week's low to really confirm a bear leg is likely underway. Now, our old friend, the Russell 2000, this contains a lot of banks, financially sensitive stocks, and not surprisingly, in light of recent macro events, it has not been doing well. It is hovering around levels that it's been at since the beginning of the year. And this is the critical level. I've been saying this for weeks and weeks and weeks, and I'm going to say it again. A close above 1813 has to be, will go on the bullish side of the ledger. If the Russell begins to trade higher, you do not want to fight this market, especially if there's momentum behind it. Now, let's take a look at the daily charts and fine tune things a bit. And let's start with the NDX. And you can see we closed right where it's a new closing high for the year. And it's a new closing high since back in August of 2022. The next level above where we are is that August high, and that's about 3.6% higher than where we are. This is last week's low. That's a very important level. If we look at the S&P, you can see we sort of double bottomed here around 40.49. And if we get above 4,200, the next level is up here around 43.26, which is about 4.6% from where we closed on Friday. Look at the Dow. And the Dow is about 3% from this January 2022 high. Again, last week's low is important. And then the Russell. And the Russell is almost dead in the middle of the range between the low of March 24th and the high of April 3rd that was tested here again on April 18th. And we're right in the middle of that trade. Now, it's about not quite 3%. If we close above this level here, I think that we're going to have to really pay close attention and assess the strength of the market at that point in time, because it could be potentially the most bullish thing that could happen, frankly. Is that going to happen? I don't know. I don't like to be in a position where I'm making predictions for myself or for other people. What I'm trying to do as a trader is identify inflection points from where I think there's going to be a sharp move relative to randomness. And we're at inflection points in all four of the indices, even the Russell. The Russell is going to trade sooner rather than later to the upper extreme you see here or the lower extreme near 1695. So as we come into the week, we are at inflection points, even though they are inflection points of a different market character. The other three are at upper extreme inflection points. So we're likely to continue this rally sharply higher, or we're in the process of making perhaps an extremely important high. Let's take a look at some technical information and see if there's any help there. Okay, this is, I use NYSE Advancing Declining Issues in a real simple manner. The red moving average is the 10-day, the red is the 10-day moving average of NYSE Advancing Issues. The green is the 5-day moving average of Advancing Issues. And what you see here is breadth. NYSE net closing advancing minus declining issues. I can make a bullish case or a bearish case. The bullish case here is we are going to take out 4,200 to one degree or another and trade higher. The bearish case is breadth is really weak at these current levels. Now, we could also have a spike above 4,200 and it would set up a very significant divergence in the 10-day moving average of NYSE advancing issues and the 5-day moving average are the same. But we'll worry about that when we get to it. From a price perspective, you have to be watching carefully. You have to be looking at internal momentum. You have to be looking at VIX. And when I say internal momentum, I'm talking about NYSE advancing minus declining issues. That's your best gauge of internal momentum, relative strength or relative weakness. So you want to see it increasing. And I'm going to talk about that again on a more granular level in just a minute. I want to first hop over here and show you VIX. Here's VIX. And VIX spiked up to just to close right at 20 on Thursday. And that's the first time we've been in a 20 VIX since the end of March. And declining VIX is generally bullish for the market, and expanding VIX is generally bearish for the market. It's a chicken or egg thing. If we see the market go higher, VIX is likely to continue to drop and flirt with this 16, 15 or lower area. However, if we turn around and we begin to trade lower and take out yesterday's lows, you're going to see a VIX spike again. So it's chicken or egg. It's not telling you anything here. This could be really bullish. It could be really bearish. So what do we default to? Price action. That's what we always want to default to, really, regardless. Now let's look at breadth from another perspective, a little bit more granular perspective. This is the SPX. This is breadth. This is obviously intraday data. And this is a 30-minute chart, 30-minute time frame. Now, this can be an extremely useful tool, both in terms of analysis, as well as providing actionable trade information. And what is really interesting about this at the moment is that we've had a huge expansion in breadth, or we had a huge expansion in breadth on Friday to a level that we have not seen since back here in the middle of March. Now, if we are in a bear trend, if a bear leg started here, we won't take out this high. We're very unlikely to take out this high, okay? And what we're likely to do is maybe best case, under a bullish scenario, is we come up here on less breadth, and then we form some sort of top, but then the next retracement, the next contraction in breadth to this area forms a much higher low when we go ripping off into 4,200, 4,300, et cetera. On the other hand, if we turn around now and we take out this lower level of something around negative 1,500, I think that would potentially be very, very bearish. So it's going to be important to watch this indicator, or the relationship between, I shouldn't say indicator, the relationship between price and breadth next week. Breadth is really not an indicator. It is actual market data. It's not a derivative of market data. It is pure market data. Indicators are at least once removed from trading, from market data. And this is market data itself. And it's just, put in the context of seeing how price is acting with breadth. Is there more or less momentum? What does this expansion in momentum mean? That's going to be an important question that will be answered next week. So that's where I will leave you guys for the weekend. I update this every single day, twice a day and all day long, actually, in a live trade room for members. If you're interested in that, go to alexandertrading.com. There's information on the website. Thank you. And if you found value in this, please like it, subscribe. Comments are welcome. I'll respond to all the comments. You guys have a great weekend. Have a great week.